And then follow up.
Welcome, Rohan. Retire into the stock market session 8 plus 1, April 13th, 2025. How are you?
I'm good. Eric, how are you?
Very good. You wanted to bring some questions about your trades today. One is with Apple, and one is with, what's the other stock balance here?
The selling the put on Hood.
On Hood. Okay. Which one do you want to discuss first?
We can discuss the Apple one first.
Okay, Apple. You did a cover call, right?
Yes.
And I know that the stock price was swinging wildly
Yep.
because of the tariff wars.
You're right.
And did Trump say he wasn't going to tariff the Apple phones? Is that what he said, the iPhones?
Yeah, but he announced that yesterday, I think, right? Or something like that.
Uh, so that should bring Apple up, right?
Yeah, yeah.
Okay.
But
Um,
so the thing was, I had a covered call which was set to expire on April 11th, right? At
uh-huh.
a strike price of 195.
195. What was Apple price Friday close? You remember? Can you bring it
Friday
up?
it closed, I think it had closed at 197 or 198 or something like that.
198. So it's just above your call. Is that right?
It's just above my call. Yeah.
Did you remember
So
how
what
much
it
you
was,
got for that? Do you remember how much you got for the premium of the call, the 195?
195, I just did a weekly call, I think. I don't know why I did a weekly call, but I just did a weekly call for $80 or something like that.
80 cents.
Yeah, 80 cents.
Okay, for the weekly call. Okay, and the stock went up to 198.
Right.
And you bought it back.
So what I did was I did a roll. So I bought it back uh, by paying like 300 and something dollars per share, $3 per share or something. And I did 1 month out on that Apple stock for $200 strike price at $10. So a net of $7 per share.
Okay, so on the math you did fine because you got more money. But I
Right.
want you to consider that when you're doing a cover call, whether it's a week or a month,
Hmm.
you're getting the benefit of the share growth, correct? Plus
Right.
the premium.
Yes.
So as a trader, we have to accept all of our wins and losses every day. We don't have the luxury to say, oh, I bought my Tesla at, you know, 80, so it doesn't matter what price. So because the price is higher, then I have a gain. You have to go day to day, week to week, month to month. So we have to look at how much money we can make this month to pay our bills. Okay.
Right.
So it's not so much important what you bought the stock at. It's important where the stock's going. Okay.
Right.
Does that make sense?
Yes.
All right. So if you wrote the 195 call for Apple, then the Apple is below 195, correct? So you got some share growth on that.
Yes, I did get a share growth on that.
Do you remember what the price was around guesstimate before when you wrote the cover call?
It was like less, it was 182 or something like that.
182,
Yeah, it
and you
was,
wrote the 195 for a week.
yeah, within a week's time. That's what it shocked me. 1 second. Let me look it up properly. 1 second.
Okay, and I'm gonna pull up my account also,
Yeah, let me look it up here.
so I can have.
So 1 week out, right? 5 days. So April 7th, and then it was April 13th, right? Yeah. So I think April 7th, I did it for, yeah, it was like 180 or 181, something like that. That's when I made the call.
Did you think it was gonna go up? That's why you gave so much
Yeah,
share growth.
I thought it would go up, but I did not expect it to reach 195.
So it was like 188,
It was 180 to
180.
182.
So
Yeah,
you got 15 points of share growth,
right.
which is great. And then you got 80 cents on the premium.
The weekly. Yeah, on the weekly.
So if you do 4.3 weeks a month, that's let's do the math on that. 80 times 4.3. 344 $344 a month per contract, and not so bad. Still
Yeah,
not a lot, but it's not so bad if you do it that way.
right.
You can make more money on the monthlies, I think, for Apple. You can make maybe $5 or $6. What do you think on the sweet spot?
I think so. I mean, initially it did not offer too much premium, but now with the volatility in the market, it is offering quite a bit of premium.
Yeah, that is. So one rule: when the volatility swings up, that's when you want to write the call, take advantage of that, because when it swings down, you get less money, right?
Right, right. So,
I have here Apple 198, and let me just go out 30 days just to look at the cover
yeah,
call. The May 16th, 33 days, 198 at the let's say 200 is paying 10.90 by 11.15. Let's say $11, and the sweet spot would be if we wrote the 205 for 840 by 860. Let's just write that down. Apple
right,
198.15. And then on Friday we have plus 273. And then for 33 days, May 16, and that's 205 strike, 1090 by 1115. I'm sorry, that's wrong. 840 by 860.
yeah,
840 by 860. Let's just say 850 limit. Can we do that?
yep,
And 198 to 205 is 7 is 685 share growth, and I'm getting 850 premium. That's close enough to the sweet spot.
right.
So we get 685 share growth, and we get 850 premium. Is that pretty good?
Yeah, that's pretty good.
And then now that's a little bit more. You're right. It's a little bit more volatility right now because of the tariff wars.
Right,
So 850 divided by 198.15 is 4.28%, 4.289%. And I always write that down for my journal to give. That's the foundation to do the monthly. You want to compare your weeklies to the monthly, or if you do it 2 month or 3 month, compared to the
hmm,
monthly. So the point is you bring in 19.8K or 20K. Apple's giving you $850 a month on that investment.
right,
4.289% a month and 42% for the year, 43% for the year. That's like the foundation.
right.
Can you hang on one moment?
Yeah,
Okay, okay. Yeah, I'm not sure why you did the weekly, but what was your plan on that? Do you know?
yeah. No, so I next time, so I did a roll on the Apple, monthly, 1 month out, but I did it at 200 and $200 strike price, because by the time I did the roll, it had come down to like 195 or 196 or something like that. That's when I put the roll.
So you did a 200 strike price for what date?
I'm just checking. I think it was 1 month out. I think it was
May
May
16th?
16. Let me just confirm that 1 second.
And then we want the premium you got.
Um, yeah, 1 second. Let me just confirm that.
Right now it's paying $11.
Right. Because I had did a roll, that's why I had to kind of pay about $300 or something like that. Uh,
Yeah, now you're paying more to get the shares back, but you're really not losing money because you're getting the share growth back also. So instead of
right.
selling it for 195, you pay $3 and you sell it for 198. And technically, does that make sense?
Yep, yep. No,
So
that makes sense.
you're paying more to keep your shares, but in a sense, it's not a loss on paper. It's just you're paying more to do the trade.
Right. So I went to 509.
You got 509
Yeah.
for the 200.
No, no. So I went to May 9th. I did not go to May 15th, 16th. I went to May 9th.
Let me look at it. Do you know why
So
you
I
did the
paid,
May 9th? You were trying to get the best price
yeah. Yeah, I was trying to get the best price because I got $10.65 of strike price
for the 200.
for the 200. Yeah.
1060.
Yes. And I had to buy the covered call for at 195 on April 11th for $3.65.
So it's 1060 minus 365.
1065 minus 365, so $7 profit. That's
Yeah,
$5 my growth.
yeah. So that's good. So I think that was a good trade. You did one thing right is that you have a net gain on the premium, and
Right.
you're rolling it, so you're keeping your shares. So that's obviously fine. The only other type of trading you can consider is that like you let the shares get assigned at 195,
Hmm.
and then you wait till Monday, and then you see where the stock is, and then you wait for it to dip again, and then you buy it at the dip.
Right. Right.
And so that takes patience and it takes time in it. And maybe if you're working, you can't do that. I'm not sure.
Yeah.
But the value there is that if you have patience, you can buy it back on the dip. What I do, write it down. 3 days. Wait 3 days. Why? Because you're waiting for a dip to buy it back. But you can't wait really more than 3 days, because you wait more than 3 days, then basically the whole week is gone, and then you're going to have a less premium because of the time decay, right?
Right.
So when you do let the shares get assigned, consider you're not going to have to pay the $3 back for one, so you get the full premium that you got before. So yeah, so you're not paying any money back, and you're going to wait after it gets assigned. You have the cash, right? You wait maybe 3 days, 1, 2, or 3 days, looking for a dip in the stock. And like if it's Tesla, you know that the stock will dip probably within 3 days, with Tesla. But Apple, maybe not. We'll see. I haven't traded Apple for a while. But you're patient, wait for it to dip, and then you buy the shares back. And then, ideally, you write the cover call right away, or you wait for an upswing if you have time. And that is why I like to get 10 good cover calls a year, and not necessarily 12, because if you got 12 and they're monthlies, you're on a strict schedule. You almost can't waste any time. But if
Right.
you're waiting for the stock to dip, buy it back, wait for the stock to swing up, sell a cover call, you're trading the market trends, you're getting the best price, and you're being patient, and you're spending some time to do that. So that's why you're not going to probably get 12. Hopefully you get 10. And if you got 9, that's fine too. 9 or 8 a year is fine too.
So would it make sense, Eric, to kind of do a put on that Apple because I put it for 195. Now, let's say if I do a put of like 185 or something like that, uh, I will get some premium from there as well, right? If I do put on 1 month out, but then,
You
yeah,
have level 3, right?
I'm sorry.
You have level 3, right? Level 3
No, I
trading?
have level two or level one, something like that. It's level zero
It
and
would be level 2, because you're doing cover calls, so that would have to be level 2. Did you apply for it, or level 3
I
is naked calls and naked puts?
oh yeah, level three I got rejected.
Why is that?
I don't know. They rejected the level three, so I have to wait till September to apply for it.
Sometimes they make you really work for it. But I
Hmm.
think what's happening is they might look at your experience and not enough experience, or they look at your account size. But I think you have a good account size. I think you have enough experience. You just have to put, you have 5 years trading options
Hmm.
and more than 5 years or plus trading stocks. Because what they do, they want to keep you out of trouble. That's what they want to do. So the level 3 trading, the final level, and go ahead and reapply for it, I guess in September, you said.
Right.
But it's going to allow you to have less maintenance and get a higher return on your trades. So instead of having, like you said, put, right?
Yeah.
I thought you told me you got naked puts, but no, huh?
No, I've not done naked puts. I've done only like I've only sold puts.
So
Uh,
just to be clear, on your naked put or cash covered put, if
Cash
you're
cover.
level 2 and you do the Apple, right, and you
Hmm.
got 10 points, right, for the 200. So the way we do it, we're gonna do the full price. So we do 1065, which is your premium, correct?
Right,
Divided by the share price, which is the current share price. I'm gonna go by Friday's price, 198, and it has some change, whatever the change was. I just put 198. I get 5.3% return.
right,
And then if you have the naked, because we're doing the full price, if you have the naked puts, they're only gonna, or the naked calls, level 3, they're only gonna hold about half. Okay,
right,
it's actually less than half, but I'm gonna say half because you have to have at least half to take the shares if they get assigned. So if you're at the 200 put, for example, instead of holding 20K, they're only gonna hold 10K. So you look at it like this: 1065 divided by 100, which is 10K. It's 10.65% return.
yeah,
Um, and here's the thing: it will be 10% return if the shares don't get assigned, right?
right,
If the shares get assigned, then you have to consider, well, they're gonna make you buy the shares. In which case, they can put you on margin where you pay half, which is 10K. But you can also pay the full amount, so you not have any margin, which is
right,
fully 20K. But the idea is that you have a few trades that you have more room to make more money, have more. You can do more things in your account with less money, and that's what level 3 is for. Is the maintenance is lower. Naked calls, naked puts, level 3. So definitely reapply for those in September.
yeah.
But your question is, should you do a put? Well, um, I think that's called the wheel strategy, where you do a put, and then if you get the shares,
Put
do
it
the
in the
cover
buy.
call. You know,
Mm-hmm.
I don't like to put. The put's different, okay? Because you don't get share growth. That's the thing on a put.
Yeah, yeah,
If you want to just buy the shares, you have the share growth and write the cover call. If the stocks are going up, then that's a beneficial to you because you get share growth plus premium, right? When you do naked put, you basically have no shares, and you're saying, I want to. Let's say you do the 200. I'll take the stock at 200 next month, and you're going to get. Or let me look at the 200 put since we're at there.
No, the
And
reason why I'm asking this is because like the Apple is already at a good price of 195, right?
uh huh.
And because of the volatility, it can go lower. So that's why I'm kind of saving myself by doing a put at a lower price so that I get premium that way and I wait till this volatility kind of gets resolved or something. Uh,
I'm gonna give you two options, okay?
mhm.
Um, Technically, you want to do the put when the stock goes down because the options are paying more. But I
Right.
think what you're saying is when the stock's at 200 and if it's gonna go down, then you want to sell the put before it goes down. Does that make sense?
Yeah.
That's
Yeah.
kind of what you're saying. You want to capture the movement to 200 towards
Right.
200. So let me just tell you the put for May 16th, which is 33 days, on the 200 is paying a little more. It's paying 12.25 by 12.45 on the 200 put. So let's just do the math on that, can we? Put 200 Apple May 16th, 12.25 by 12.45. Let's just say you get to 12. Let's just say you get to 12.25, which is the bid. 12.25. Let's do the math on that. You're going to take the shares at 200 in this case, okay, on the 200 put. So you did it full price, so you do 12.25, 12.25 divided by 200. So it's 6.1%, a little bit more, a little bit higher.
Right.
However, I wouldn't do the 200 put. I would go deeper, lower,
Yeah.
because you don't want to have this take the shares and then the shares drop, right?
Right. Right.
So it's beneficial to you to have what's called a buffer. We
Yeah.
have a sweet spot for the cover call. It's the same thing for the put. You want to do a sweet spot for the put. So if the stock is, let's say, 200, closest to the 200, and you go the 190 is paying 830 by 850. It'd be the 190, the one you write, because that's the stock is 198.
Right. So you go $8 out, right?
$8 lower, that's 190, and then you get $8 premium for the 190. Makes
Yeah.
sense. So that's the classic sweet spot.
Right.
8, 30, 50. So let's do the math on that. 830 is the premium. One, and you go 190 because that's when you take the stock. So you go 830 divided by 190. 4.36%, still good, and you won't lose any money unless Apple goes below 190, and you got an
Correct.
8 point buffer. It makes sense.
Right.
That's a classic one. So all you have to do. Oh, but I have another option for you. Can I tell you the other option?
Yeah.
The other option is to write a deep in the money cover call. And what I'm doing now, the stock swung up to 200, right? Because it was
Yeah.
160, 170. So what you're doing, because the stock swung up, you want to capture all that share growth. Okay. So if the stock is 198 and it just went up drastically, which it did, I think it was up. Well, it was down, then it went back up, right? So you're gonna go into money. Let's say it was 180 before, right? Not that long ago.
Yeah. The 1 week back. Yeah.
So what you're gonna do, you're gonna write the deep in the money, which is the rich man's trade.
Yeah.
Why is it a rich man's trade? If I write the 180 cover call, why do we say that?
Oh, because you're trying
Say
to protect I mean, you're trying to protect your money, right?
right, because the rich man doesn't need to make that much money.
Exactly.
They
Yeah.
want to do a safe. They want to protect the money and do a safe, small investment. They're very happy with a small return.
Right.
So when the stock swings up, we can capture that growth by writing deep in the money cover calls. Still get some decent premium. Let's take a look. May 16th, Apple, 33 days. We go to 180, which is what the stock was before. I'm just going by what it was in my mind recently.
Yep.
So 180 cover call. It's showing me 2420 by 2440. Is that what you got?
Right.
So what I do, you take the 2440, you add it to the 180 price, which is the price you agree to sell it, and we get 20420. Make sense?
Yeah.
So you're getting paid to 204 is what you're doing. 24 premium, a lot of premium. You're agreeing to sell shares at 180. But the share price currently is 198 and 15 cents. So you do 204.20, which is what you're getting paid to. You subtract 198.15, which is your true profit gain. Okay,
Right.
let's do that. 204.20 minus 198.15. You're still at a 6.05 premium. Did I do that right? That's still great.
Yeah. It is. Yep. It is.
You're still getting $605 basically for this trade for
Yeah.
1 month, and here's the magic: you're protected all the way down to 180. You don't lose any money. Right? Think of all the Apple shareholders who, when it goes down 10 points, they're at $1,000 at 100 shares. This one could go down 18 points, and we didn't lose any money because we got paid 24 for the 180.
Right.
And what I generally do. Any questions on that?
No.
So it
That makes
protects
sense.
you on the way. So you still get 6 points. Protects you on the way down. And safe trade, more safe, higher chance of success. Write down higher chance of success. Remember in Palantir, the stock dropped and you had to take all that share growth loss.
Right.
If you just done the deep in the money cover call like a rich man, you'd have made less, but you would have
I
more
would have not
protection.
lost it. Correct. Correct.
Yeah.
I mean, I have recovered that money, but still, I could have done this deep in the money covered calls, rich man's trade.
Now, if you look to the put, if you wrote the 180 put, you don't get paid that much.
Yeah, you get paid $5 or
When it
something.
put, it's paying well, it's paying 560 by 570,
Right.
almost.
Yeah.
Um, it's actually pretty similar, But I like to have the shares. You get a little dividend.
Yeah.
I don't know if you care, but you get to vote. If you have the shares, you get to vote.
Yeah.
Um, Back before the COVID, you can go in person. Now they have everything. Everything is through the mail.
Yep.
Okay. So option one, you can write it. You can write a naked put or cash covered put. Option two, you can write deep in the money cover call. Now, at the expiration, I wait till the last day and I go ahead and buy back my cover call. So I'll pay back the $24, but I still count that $6 premium, right? Which is the
Right.
true, right? Now, the only disadvantage of the deep end cover call is your upside's capped, so we
Yep.
can't make more than 650. If we did the true sweet spot at 198 price, we would sell the 205, and we would be able to get 6 more points of share growth. Plus, I think it was 5 points of premium, which is like more money.
Right.
We're not protected on the downside. And like you said, to take advantage of the upswing, you want to write the naked put. You can write the put, or you can do deep money cover call. You can see which one's better.
Yeah.
Make sense?
Yep. That makes sense.
Um, and on the last day before expiration, which is there should be little to no intrinsic value, little to no extrinsic value, which is the fluff, which is a premium. You just buy back your shares, and then you write the next cover call.
Right. Right.
So you'll be giving back that 24 points, but you'll be taking away the 6 points.
Got it.
If you
So basically it's
if
$18.
yes, if the stock was same price, 198, you'd be paid $18 to buy it back, and you would still keep that $6 to 24. Make sense?
Yes.
Questions on that?
No, this makes sense. So it's always like this, is it? That you should be able to buy it back because it does not have that intrinsic value. It only has that intrinsic value. It does not have that extrinsic value.
It might have like 10 or 20 cents, but if you do it
Right.
like about 1 o'clock, right before it closes, that value should also be very low.
Got it.
And then I like to write the next call right away, kind of like you did. So I'm going to get more premium right away. But you could buy it back and just hold your shares. If you're confident, you buy back and hold your shares and see where the stock is Monday. Maybe it goes up, you get a share growth, right?
Yeah.
But if you don't, but if you write your cover call on Friday, then you got the premium in hand. You don't have to worry until the next month. It takes the
Right.
guesswork out. So it's really
Yeah.
just guesswork. It's guesswork is what it is.
Right.
Questions on that?
No, I normally don't wait. If the price is going up that day, I just do the covered call.
Do you know the advantage of waiting, of being patient?
Whenever I've waited, it has always gone down. So
Yeah, well, if it's going to go down, then you wish you wrote the cover call.
yeah, yeah,
But the idea of waiting is it can go up higher, and then you write the cover call on
yeah,
the upswing,
yeah.
buy it back on
Get much more
downswing,
value.
and then
Right.
downswing also write the puts because the puts are paying more on the downswing.
Yeah.
Buy the put back on the upswing, write a cover call on the upswing, buy the cover call back on the downswing. Trading.
Right.
It takes time. It's easier said than done.
Yeah.
Uh,
No, yeah, I'm getting the hang of it. Just trying to learn to have patience. That's one thing.
think in your mind that you're getting something like $600 a month, let's say, on your Apple, or $800 a month, depending on where you register a call, and that's your business. That's bringing in consistent money. You do have to manage these share price fluctuations.
Right.
Sometimes the share price, let's say, it goes down to 190, then you have to write to 195 next month. So technically, you're losing, 10 points of share growth. You're only getting 5 points back or 8 points back. But the theory, if you did journal entries, you should have 10 cover calls. Let's say between 5 and 8. Let's say 7 points a month. That should be 70 points, which is $7,000.
Right.
So I doubt your Apple dropped 70 points. You see my point?
Yeah, yeah.
Now the goal is to get to the cash cow. Whereas, which if you're an Apple, let's just say that's 20K investment, right?
Hmm.
19.8K, 20K investment. The first year you're bringing 7,000. Second year you bring another 7,000. Third year you're gonna hit the cash cow where you bring in so much premium, it already paid for your investment.
That's
And
right.
that premium to your account, as long as you manage the money well, you basically doubled your money. You brought in 20K. You brought 20K premium. And at that point, your investors pay for, and it's just the rest of the cover calls and the naked puts you're doing are just icing on the cake.
Yeah,
Because why? Because if you take 20K and then you get 20K premium, even if it took you 3 years, okay, which is not bad, the stock can go down and you haven't really lost the money because you have all your investment paid for.
yeah, yeah.
That's why it's good. So I want you to take a strict monitor in your accounting in your journal to see how much income you got premium from Apple, from Tesla, from Palantir. You're gonna go for that cash cow position, and when you get that cash cow, can you let me know?
Okay. Yes, I will definitely.
I'll congratulate you. Okay, now you had another question on another trade.
Yeah. So
We have a few minutes, and then we can
so it
wrap
was
up.
basically about selling the put on the hood. So what I did was I did sell the put on the hood last yesterday on Friday uh for $33 strike price, and I got like $1.56 for it.
Were you doing that because you were giving the share growth? Is that why?
So I don't have so this is a different account and I don't have a hood in there. So I thought, okay, let me just try it with doing a put on the hood. And I was seeing like I was getting about 5% ROI on that. So that's why I decided to go with it because the market is so fluctuating and the hood price went up to $41. So I said, okay, let me try to write it down for $33 1 month out, right? Because the hood price had gone down to $33.
And then
Just
you
for,
wrote the
for the
naked
fact.
put. You wrote the cash cover put
Yes, I did a cash
for
covered put.
what strike?
$33.
How much did you get?
I got
You
$33.
said
I got
you said it was 5% return. Is that right?
I got $1.58.
And then do you remember what the share price was?
Share price was at $41. 41
So you
20.
went way down. You went way down,
Yeah.
and you still got with it. That's kind of like a rich man's trade. Good job on that. You didn't
So
get a lot of premium, but hey, that was a safe trade because the share price was 41.
yeah, I got like 4.78% return.
You sold at 33, way down, and the stock is now
It's gone up.
43.68.
Yeah, it went up to 43.68.
By the way, Robinhood's going places. I changed my mind about them at least for the stock price. I think the stock is good, and the cover calls and puts are good. I still don't like that they don't let you go short, and they'll probably play games with you if they wanted to turn your app off, which they could do.
Right.
But uh, I think the stock is going to do well. It's just been doing good, and it's paying a good cover call.
Yeah, it's being. I mean, the thing is, the company is expanding in different markets, like the Europe markets and the Asia Pacific, and they're doing a lot of cryptos and doing stuff. So I think it's going to grow.
They're
Uh,
doing crypto, yeah.
yeah.
You know, because they have a lot of young accounts.
Yes, they have a lot of
Young
young.
people are into crypto.
Exactly.
I don't think
So
they know what they're doing in crypto. But the young people love to buy it. They love to buy Bitcoin and Ethereum and I don't want to
but
take too much of your time. How's your time?
so I'm. I mean, I think my daughter is not planning to go, so I'm good.
I
I
would
had
go
to
if you
take her
want. You can go a
somewhere.
little bit longer.
Yeah, so I can stick a little bit. So my question was, Eric, on that was, okay, I've done this transaction. Now should I wait because I'm already like 20% profit or 30% profit on that because the stock price went up to 43, right? So would it make it, and this is within a day's time. So would it
So,
make sense like if by tomorrow or
what is
by
the
Tuesday,
expiration on your put?
the expiration was May 9th.
I know. The first lesson is what? Tell me what the first lesson
1 month
is.
out. 1 month out. Huh? I did
What's the what's
26
the
days.
what's the first lesson on this trade? To answer your question,
First lesson.
let it expire.
Oh, I should go 1 month out, 30 days or more.
No, but no, that's not my point. I'm answering your question. What do? Do you buy it back? The first lesson is to let it expire, because that way you don't get any premium back. Be
Let it
patient.
expire.
Yeah, be patient. Let it expire. But your question is, should you buy it back if you had a nice profit, right?
Right, within a couple of days, right?
Right. So the other lesson is, if you can improve your return
Yeah.
by the expiration date, yes, you can buy it back. So May 9th, right? So that's 20 days.
Right.
Let's say 20 days. Okay. And your 158 has turned to 80 cents.
Yeah.
I would only buy it back if I'm going to do another trade right away. And the trade I'm going to do is much better. Like,
Okay.
since, like you said, within a couple days, you got 80 cents, you got 50% return, correct?
Right.
So I would buy back. Let's say if you're going to do the May 16th, this is what I would do,
Uh-huh.
and I would do either a put or a cover call.
Right.
And I wouldn't get no, I wouldn't get 80 cents or 158. I would get a little bit more. I would look to get like on the put. I don't know what happened with that. I think I pressed something on the. I would buy, if I bought it back, I would do the May 16th, which gives me 33 days, which is the proper month. And then on the 43, okay, so the 44 is paying 480 on the cover call. So I would do about, let's say, the the market might go up right now. I'm just saying it might.
Right.
And so I would do like the 47 for $3, or the 46 for $4. That's what I would do.
For the covered call, right? You
Yeah,
mean?
yeah,
Yeah.
and that's the sweet spot. You can also go in the money if you want. If you want to protect yourself from the downside, you go in the money. That's fine. On the put, I would
Hmm.
go. You were very safe to do a 33 put when the stock was higher.
Right.
But I would go something like 41 for 360 by 480, or 40. I'd go with 41 or 40. 40 is paying 360 by 325 by 4. So you can get
Hmm.
350 for the 40, or $4 for the 41, right around there. That's what I normally would do.
That's what you
But
do.
but if I wanted to protect myself, I would go lower, get less money.
Yeah.
If I thought I was going to
Yeah.
go higher, I would do the higher call and get more share growth.
Got it.
So consider that if you do buy it back, even if you only pay 80 cents, and you write the next trade, and let's say the stock goes where to go down, then you blew your trade because you had the 33 put, which worked much better for you. The stock went down. You were going to get 158, and you wouldn't lose any money. You see,
Yeah.
but you decided to try to improve that, to buy it back. You gave back 80 cents. You did a more aggressive trade, which lost. You see,
Right. Right.
so you have to look at each trade month to month. Put in your journal and see how you do. If you're finding out that you're really not improving your trades, then cut back, peel back. Just go with your initial. They say your initial instinct is always right, or usually right. Do you hear that?
Yep.
That's intuition. Your first guess is usually right. Have you heard that?
Yeah. Yeah.
It's the people. It's like your intuition is working for you. It's like you're saying, don't double guess yourself. Don't outthink yourself. Don't what's the word? Don't second guess yourself. That was it. That
Right.
was it.
Second guess yourself. Yeah.
So because you had a perfect trade, even though it was a humble trade, 158,
Right.
and you bought it back, and your next trade maybe it fell. We don't know. But if you
Yeah.
want to be aggressive, I would do the $4 on the put or the call.
Got it.
And then you're looking to have a consistent. At the end of the year, you're looking at for a hood, you're getting 350. That's $3,500 a year. That's all you're looking
Right.
at. 35
Yeah.
points, and then see how you do. If you want to buy back, you want to start buying back your call because it was only a few days. Fine, but you have to really show for that you're improving your trade, not that you're taking a risky trade that could lose money. And I think it's gonna be real choppy this year. I think
Got it.
so. Be prepared. It will swing up and it will swing back down,
Yeah.
like Nvidia, like Nvidia.
Yep. Yep.
However, I heard Nvidia has a big order now for chips. I hear China is gonna buy some Nvidia chips. You hear that?
Right. I just read that. Yeah, 8.6 billion or something like that.
So that should be good for them. We'll see.
Yeah.
I hope so.
Yeah.
Look to get some gold.
Got it. Yeah.
I want to talk to you about next session about the 5 levels of ability. Write it down. You may have heard me talk about that. 5 levels of ability. And the reason this is important, it's a philosophy that teaches you check where you are on the scale, because that's going to be the money you make. The level of ability is going to be equal to the money you make. And when you go into any field, you'll see a person, a man or a woman, operating at a certain level of ability. If they're novice, they're going to get novice money. If they're adept, they'll
Right.
get more money because they're an adept. They get paid for their skill and their knowledge. And you have to figure out where you are in the stock market. If you're being consistent, you're getting good money. If some people, they have to face the facts. Your trading is terrible. You're losing money.
Yeah.
Look in the mirror. You're a novice, and you're gonna continue getting that money until you improve your trading.
Got it. Yeah. Yep.
Questions?
I think this was good, Eric.
Anything else?
Nope. No. No.
Call it a win.
I think I should focus more on the deep in the money covered calls, especially in these times.
Yeah.
Look a bit more on that.
They say that the thing that will get you is the drawdown.
Yeah.
Because like we talked about, if you lose 50%, whether it's of your account or it's even if it's one position, you have to get 100% return to get that back.
Yeah.
So it's a drawdown. You have to play great defense, control your drawdown. So yes, so I would look at the deep of the money. If you can be patient and you can take less premium, then that's a smarter, wiser way, because the market's not always going to go up,
Right.
and these people are buying calls.
Yeah.
Man, it's a very tough battlefield when you buy calls, because your whole investment can go to zero.
Right.
And we're selling the calls, so we're getting the money up front, so we really have a much less risk.
Yep. Yep.
And if our risk is exposure to the share price, our risk is exposure to the share price, because share price can go down. But then you're writing the lower call, and you would start eliminating all your exposure by writing the lower call, or writing selling the lower put. Remember I said, if this trade doesn't work, you got to spray paint your car pink.
Yeah. Yeah.
You want to do a trade that chances are so high, like that you would literally spray paint your car pink if it didn't work out.
Right.
That's where you want to. That's how you want to protect your money. That's the kind of trade you want to do, even if you make less money, because at the end of the day, it has to do with being consistent. Not by nobody cares Rohan, if you double your money, including you, if you're gonna lose this next month.
Yeah. Yeah. That's true.
So
100%.
consistent small gains, like I say, take a small gain, walk away.
Yep.
Thank you, sir. I think I'll hear from you at 5, but also next week.
Yeah. Sounds good, Eric.
All right, thank you, sir. Have a good day.
Thank you. Bye.